Bring in Tony, as we mentioned, Tony Crescenzi, Executive Vice President and Market Strategist at PIMCO, is with us as well. Tony, good to see you. It's been a while. Great to have you back. Why don't we come to that question first of all? What are your observations today in the way that yields spiked yesterday and then on the long end at least back down to where they were 24 hours ago, but some other markets like commodities and the dollar definitely holding on to the big moves?
Well, the ghost of taper tantrums past is not so scary, it seems today. What the Fed did yesterday was regain control of the inflation narrative, whereas previously it was in the hands of many other investors, many speculating in the areas that Mike was talking about, and some of the excesses coming out. There are a lot of top trades for the reflation theme. For example, the yield curve steepener positions in the U.S. dollar on the short side, and the commodities markets that are being cleaned out. But when we take a step back and look where markets are pricing in long-term interest rates based on the gauges that we look at in the bond market, it seems to be a benign outcome that's expected. And this could, in fact, help sustain the economic expansion in the end, with the Fed giving a bit of tough love in order to keep inflation expectations in check. And this could be very favorable for equity, for credit, for private assets and housing, all of which we would recommend a continued overweight in, especially now that the inflation story, the Fed has regained control of this narrative and anchored inflation expectations at a level that market participants enjoy.
Are those assets only attractive until we do get to the point of rates going higher, or even when they do start to be hiked by the Fed, as long as it's kind of calmly, then those assets can keep doing well?
Well, Wilfred, it's a very good question, and it depends on where an investor thinks markets are and the economy is in terms of the cycle. We would suggest that based on the equity market's risk premium, call it around 3.5% or so, that the market pricing is consistent with the mid-cycle average, which is to say there may be some time to go. But then again, the unemployment rate by the end of next year could reach the late cycle type levels, and late cycle dynamics could come into play. And the idea of Fed rate hikes with potentially quickening momentum, who knows, will come into play. But for now, it looks like the runway is clear, in part because the economic story is very good. PIMCO would forecast economic growth to stay sturdy next year above the long-term trend, which is in the 2s. So we would expect it to be closer to 3%. I think that's somewhere around the consensus. And that's certainly a number that is good in terms of cash flow generation, which is a good news for investors generally.
Shepard Smith here. Thanks for watching CNBC on YouTube.